Pullback or preparation? What if the recent drop in gold was not weakness, but positioning? What if institutions were not stepping away, but stepping in quietly? While headlines focused on volatility, a major bank raised its projection to $6,000 gold and $105 silver. That is not emotion, that is conviction. Because when forecasts rise during fear, something deeper may be unfolding beneath the surface. Currencies are under pressure, debt levels continue to expand, and monetary leadership stands at a possible turning point. So the real question is not whether this was a correction. The real question is, correction before what? And the answer may reshape how serious capital prepares for what comes next. In recent weeks, commodity markets have moved sharply. Prices advanced quickly and then retreated just as fast. Many observers called it a correction. Some assumed the rally had ended. Others believed the trend had finally reversed. But experienced analysts did not react immediately. They understood that volatility alone does not confirm weakness. In strong, long-term cycles, temporary declines often appear before renewed momentum. Markets rarely move in straight lines. They expand, they pause, and then they adjust. When gold pulled back from recent highs, retail traders focused on short-term charts. They saw falling prices and assumed sentiment had shifted. Institutional investors looked deeper. They examined macro conditions, capital flows, and structural economic pressures. From that perspective, the decline did not signal collapse. It suggested recalibration. Then came the updated outlook from CIBC. Instead of reducing expectations, the bank raised them. Gold was projected to average $6,000 per ounce. Silver was expected to average $105. These revisions were substantial compared to earlier forecasts. This raised an important strategic question. Why increase long-term targets during short-term weakness? Professional investors interpret corrections differently. When macro drivers remain intact, price pullbacks can create temporary gaps between market price and long-term value. Institutions often treat such phases as adjustment periods within broader trends. They focus not only on recent price movements, but on the forces behind them. Inflation concerns remain present. Government debt levels are elevated across major economies. Geopolitical risks continue to influence trade and energy markets. Confidence in traditional safe assets is being reassessed. When these factors combine, precious metals often gain attention, not because of speculation, but because of capital preservation. CIBC's analysis suggests that the broader upward structure in gold remains intact. The recent decline is viewed as an interim movement within a larger cycle. This distinction is important for business leaders and entrepreneurs. Companies hold reserves in cash and bonds. They depend on currency stability and predictable rates. But when uncertainty increases, assumptions about stability can weaken. If macro conditions continue to support hard assets, short-term volatility may carry less importance than long-term positioning. Silver also deserves careful consideration. While it often follows gold, it has independent demand from industrial sectors, including technology and renewable energy. This dual role strengthens its strategic relevance. CIBC's upward revisions indicate alignment between monetary conditions and structural demand drivers. Markets always present two narratives. One says the drop signals exhaustion. The other suggests it reflects temporary repositioning inside a durable trend. Serious decision makers do not react to headlines alone. They ask whether the underlying drivers have changed. If those drivers remain active, then a pullback may represent movement within a continuing cycle. The central question remains clear. Was this decline the end of momentum, or a pause before the next phase? To answer that, one must look beyond short-term volatility and examine the forces shaping global capital today. Markets do not move only because of numbers. They move because of trust, and trust in today's global system is under pressure. Across continents, governments are facing rising debt burdens. Political tensions remain unresolved. Trade alliances are shifting. Strategic resources are becoming tools of negotiation. None of this creates stability. It creates caution. For decades, investors believed that uncertainty was temporary. A conflict would emerge, then settle. A financial shock would occur, then recover. But the current environment feels different. Instability is no longer rare, it is frequent. It appears in cycles, across regions, and across industries. Institutional investors are not blind to this pattern. They understand that geopolitical risk now carries a structural premium. In simple terms, it adds long-term value to assets that protect capital during uncertainty. Gold has historically served that role. When political systems face stress, gold often absorbs defensive capital. It does not depend on government promises. It does not rely on corporate earnings. It represents stored value without counterparty risk. CIBC's revised outlook reflects this reality. Their analysts appear to believe that geopolitical tensions are not short-term events. They are persistent forces shaping global capital allocation. Central banks are also part of this story. Over the past few years, several central banks have increased gold reserves. They have reduced exposure to certain foreign assets. This behavior suggests a quiet but important shift. Sovereign institutions are diversifying away from single points of dependence. This is not dramatic, it does not make daily headlines, but it sends a signal. When countries begin adjusting reserves, they are preparing for potential disruptions. They are hedging against currency instability and geopolitical fragmentation. At the same time, the US dollar remains central to global trade. However, questions about long-term currency strength continue to surface. High fiscal deficits, expanding debt, and persistent inflation pressures create uncertainty about future purchasing power. Some analysts refer to this as currency debasement risk. It does not imply immediate collapse. Instead, it reflects gradual erosion over time. In such an environment, capital searches for anchors. Gold becomes one of them. Silver, though more volatile, also plays a strategic role. Unlike gold, silver carries a dual identity. It is both a monetary metal and an industrial input. Its demand is influenced by economic expansion, renewable energy systems, electronics production, and technological innovation. This dual nature makes silver complex. During strong industrial cycles, it benefits from manufacturing growth. During monetary instability, it benefits from safe haven demand. CIBC's projection of silver averaging $105 suggests that they see convergence between these two forces. Industrial demand may remain firm, while monetary hedging increases. For business leaders, this raises important considerations. If geopolitical uncertainty persists, supply chains may face disruptions. Commodity prices may remain unstable. Currency fluctuations could impact import and export margins. Companies that ignore these macro risks may find themselves exposed. Institutional investors appear to be adjusting portfolios quietly. They are not waiting for headlines to confirm instability. They are positioning based on probability. The broader question is not whether a single conflict will escalate. It is whether the global system is entering a period where uncertainty becomes normal. If that is the case, then assets tied to political promises may face scrutiny. Assets tied to intrinsic value may gain attention. CIBC's stance suggests that they believe this structural shift is ongoing. The recent pullback in metals, therefore, does not erase geopolitical risk. It does not eliminate currency concerns. It does not resolve debt pressures. Instead, it may simply represent temporary repositioning within a larger defensive cycle. And if geopolitical premiums remain embedded in global markets, then the upward bias for precious metals may remain intact. The real issue is not whether tension will disappear. The real issue is whether the global system has already changed in ways that make traditional safe assumptions less reliable. If it has, then capital will continue to move quietly toward protection. While geopolitical risk shapes the background, monetary policy determines the speed of capital movement. In the United States, leadership at the Federal Reserve carries enormous influence. Even small signals from policymakers can shift markets within minutes. When reports surfaced about a potential transition at the head of the central bank, investors reacted quickly. Prices moved, yields adjusted, precious metals pulled back. At first glance, the reaction seemed logical. A candidate perceived as hawkish often signals tighter policy. Tighter policy suggests higher interest rates, and higher rates usually strengthen the currency while pressuring gold. But institutional analysis rarely stops at first impressions. CIBC's analysts took a more measured view. They examined not just the label of hawkish or dovish, but the deeper economic constraints facing policymakers. The United States carries a significant debt burden. Servicing that debt becomes more expensive when interest rates remain high. At the same time, economic growth requires affordable credit. Businesses need financing. Consumers rely on manageable borrowing costs. These realities create tension inside monetary policy. On one side, central banks must control inflation. On the other side, they must protect economic stability. Maintaining high rates for too long can slow growth and strain government budgets. CIBC appears to believe that, regardless of leadership changes, structural pressures will eventually push rates lower by 2026. Not because policymakers prefer lower rates, but because the economic system may require them. This expectation is critical for gold and silver. Precious metals often respond to real interest rates, meaning nominal rates adjusted for inflation. When real rates decline, gold tends to strengthen. Investors become less attracted to interest-bearing assets and more interested in preserving purchasing power. If inflation remains persistent while policy gradually shifts toward easing, real yields may compress. That environment historically supports precious metals. The recent pullback, therefore, may have been triggered by short-term uncertainty about policy direction. But if long-term rate trends still point downward, the broader thesis remains intact. CIBC's interpretation of the potential Federal Reserve transition reflects this reasoning. Even if a new leader initially signals discipline, the structural debt environment limits how restrictive policy can remain. There is another dimension to consider. Balance sheet policy, often referred to as quantitative tightening or easing, also influences liquidity. When the central bank reduces its balance sheet aggressively, liquidity tightens. When it slows or reverses that process, liquidity expands. Liquidity often finds its way into asset markets. If financial conditions tighten too quickly, markets may weaken. Policymakers are aware of this. They monitor stability risks closely. No central bank wants to trigger systemic stress. For entrepreneurs and business leaders, these dynamics matter deeply. Financing costs affect expansion plans. Currency stability affects import pricing. Interest rate shift influence capital allocation decisions. Understanding the likely direction of policy is not speculation, it is risk management. CIBC's forecast implies confidence that the macro structure favors easing over tightening in the medium term. If that view proves correct, then temporary weakness in metals may not represent trend exhaustion. It may represent adjustment before renewed momentum. Markets often react sharply to political headlines, but long-term trends are shaped by structural necessity. If the economic system cannot sustain prolonged high rates without damage, then the path of least resistance may eventually lead toward accommodation. And in that environment, assets designed to preserve value, rather than generate yield, may continue to attract serious capital. The question is not whether monetary leadership will change. The deeper question is whether the economic system allows for sustained restriction at all. If it does not, then the recent volatility may prove to be transitional rather than transformational. Beyond daily price movements, beyond central bank transitions, there is a deeper issue shaping this entire outlook. It is the question of trust. Modern financial systems are built on fiat currencies. These currencies are not backed by physical commodities. They are supported by policy credibility, economic productivity, and government stability. For decades, this structure functioned efficiently. Confidence remained high. Bonds were treated as risk-free. Cash was considered stable, but the confidence is now being tested. Debt-to-GDP ratios in many Western economies are near historic highs. Governments continue to run fiscal deficits. Public spending remains elevated. Servicing national debt becomes more expensive as interest costs accumulate. When debt rises faster than growth, policymakers face difficult choices. They can raise taxes, they can cut spending, or they can allow inflation to reduce the real value of debt over time. Inflation, in this context, becomes more than an economic statistic. It becomes a policy tool. If inflation runs moderately above target for extended periods, the real burden of debt declines. However, purchasing power also weakens. Savers lose quietly. Fixed income holders see erosion over time. Investors are aware of this dynamic. CIBC's broader thesis appears to acknowledge that the concern is not limited to one country. The shift is global. Trust in sovereign balance sheets is under quiet reassessment. At the same time, the idea of a risk-free asset has become less certain. Government bonds once represented unquestioned safety. Today, they carry duration risk, inflation risk, and policy risk. When traditional safe havens appear less predictable, capital searches for alternatives. But the list of alternatives is short. Gold has thousands of years of monetary history. It does not depend on policy decisions. It does not carry default risk. It exists outside political systems. For this reason, when systemic confidence declines, gold often re-enters serious portfolio discussions. Silver shares some of these qualities. It also benefits from industrial demand linked to technology and energy transition. If infrastructure investment continues globally, silver demand may remain supported on multiple fronts. CIBC's projection of gold potentially averaging $6,500 by 2027 reflects this structural view. The bank is not forecasting a straight line upward. Volatility is expected. Sharp pullbacks may continue, but the larger direction in their assessment remains positive. For entrepreneurs and business leaders, this analysis serves as a warning rather than a prediction. Currency risk affects import costs. Inflation affects wage structures. Bond volatility affects pension funds and corporate reserves. Precious metals, in this framework, are not speculative assets. They are hedging instruments against systemic fragility. The recent pullback, therefore, may not represent failure. It may represent fluctuation inside a longer transition. If debt continues rising, if monetary policy eventually shifts toward accommodation, if inflation remains persistent, then the pressure on fiat confidence may intensify. And when trust weakens, capital does not disappear, it relocates. CIBC's data-driven positioning suggests that they see this relocation already beginning. The raised forecasts imply conviction that the structural forces remain active despite short-term noise. The path toward $6,000 gold or $105 silver may not be smooth. Markets rarely reward patience without testing it. But volatility does not invalidate direction. The central issue is no longer whether metals can rise during crisis. The deeper issue is whether the global monetary system is entering a phase where protection becomes strategy rather than precaution. If that shift is underway, then the recent correction may one day be viewed not as the end of a cycle, but as a brief pause before a more decisive repricing of value.